This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks, and welcome to Money Talk. Here's a rundown of today's show. We start with Tom Peckloff of the Ottawa Business Journal, and he'll bring us up to date on the Ottawa business scene. Then to Friday's Morning Buzz with BNN's Francis Horodelsky, who talks about a recent study on crowded trades, reference the old adage, don't follow the crowd. After the break, BNN's Amber Canwar sits down with Don Tapscott and Alex Tapscott, co-authors of The Blockchain Revolution, to discuss the potential impact of blockchain technology. And on to Matt Hendricks, Senior Vice President, National Sales at Sprott Asset Management. After the news, we go to an interview with Eric Nuttall, Portfolio Manager of the Sprott Energy Fund, who joins BNN's Catherine Murray to discuss why it's time to buy into Canadian energy you are investing for the long term. Then to BNN's Paige Ellis, who discusses how Hydro One has applied for an incentive-based rate program that could potentially reduce Ontario residents' electricity bills. To conclude this afternoon's show, we go to Francis Horodelsky and a fascinating interview with Roy Sebag, co-founder of BitGold, and James Turk, founder of Gold Money. But first, to Tom Peckloff of the Ottawa Business Journal. Well, it's that time again. I'm joined by Tom Peckloff of the Ottawa Business Journal. How are you, Tom?
I'm doing well, John. How are you?
Enjoying spring, thank you.
Yes, absolutely.
Now, you could probably take up the whole show talking about the week that was in Ottawa business. A major funding announcement, plenty of earnings reports, and accolades for 10 Ottawa firms.
Yeah, to say we were busy at OBJ this week would be a definite understatement, John. But let's start with the funding announcement. Ascent Compliance announced $20 million in venture capital on Wednesday. Now, the round is led by Boston-based Volition Capital, with participation from Open Text Enterprise Application Fund, the Business Development Bank of Canada, Industrial Research Assistance Program, and Royal Bank of Canada, as well as private investors. It means new office space on Coventry Road, plus 100 new employees sometime in the next 12 to 18 months. One of the investors was saying that he saw a great leadership team, a sizable unmet market need, track record of success, and a leading product solution. And what that solution is, it's a software as a service solution, and it's used by 30% of S&P 500 product companies to help them meet the ever-growing number of compliance regulations that are out there nowadays.
And plenty of earnings reports this week, Tom.
Yeah, we'll try to narrow it down to just three. We'll start with Shopify. First quarter revenues of $72.7 million, topped expectations. They still posted an $8.9 million loss for the quarter, or 11 cents per share, projecting second quarter revenue between $79 and $81 million, and full year revenue between $337 and $347 million. Over at Mitel, another strong quarter, according to CEO Rich McBee. Their mobile and cloud businesses are leading the way. New record revenues for cloud business of $45.8 million. Mobile business was up 55% year over year. Overall, Mitel posted revenue of $276.8 million for the 3 months ending March 31st. That's up 3% from the same quarter last year. And looking ahead to the next quarter, projecting revenues between $285 and $305 million. And then finally at Calian, another quarterly revenue record there, $68.1 million, up from $61 million the same quarter last year. According to top-level executives, that is a testament to the entire team. Calian management will continue focusing on key strategic initiatives over the second half of its fiscal 2016, and it is expecting organic revenue and earnings growth because their traditional markets are now stabilizing, projecting fiscal 2016 revenue between $250 million and $280 million, and a net profit between $1.50 and $1.80 per share.
And what awards were announced this week?
Well, OBJ has announced Ottawa's fastest-growing companies for 2016. You've got technology, management consultants, legal practices, communication firms, all on the list. A top company, FullScript, experienced 3-year revenue growth of more than 1,200%. You can get the full list. It's available on obj.ca, and we will start running features of each company that made the list on our website, and that will start tomorrow.
And what's on the OBJ radar this coming week, Tom?
Well, the CEO Talk series happens this week, as does the Mayor's Breakfast. Also, 3dprinter.com is in New York at a trade show displaying their new chatbot, so I'm going to try to catch up with them there.
That's a great update. We'll talk to you same time next week, and have a good one.
You too, John.
Now to Friday's Morning Buzz with Francis Horodelsky.
Start off just talking about the jobs. A couple of things. Of course, the Canadian job numbers is kind of like who knows. Every month, it's always some kind of remarkable surprise. Of course, we should look at like a 12-month running average or a 5-year running average. So we'll see the Canadian jobs numbers, the U.S. jobs numbers. Two things. I heard yesterday Goldman Sachs had increased their own number to 240,000. I think the consensus is around 200,000. But I was reading a report from the economics team at RBC talking about the Verizon strike, and apparently it shouldn't have any effect on the numbers, but you never know how sometimes those things come into the calculations. And I gather it was happening kind of midweek in the survey week that where the jobs numbers comes out for any particular month. So that may complicate the number, may not show up at all, but it's something just to keep in the back of your mind when you see the headline. If it's, I don't know, if it's 150,000 or something, there might be something behind the number. So what do you think of these numbers on a monthly basis? We spend so much time on them.
Yeah, we do. I mean, 200,000 is the estimate. I think the survey's, statistical error from the sample is 80,000. So, and then we worry about 10,000 plus or minus 15,000. But, jobs are key. That's why there's importance. But you got to be careful. Like, I sort of agree with you. I wouldn't focus so much on the monthly numbers, but the underlying trends in what we're seeing in the labor market.
And I think the trend so far this year, I believe, is 209,000. The average is 209,000 per month this year.
That's right. So that's jobs. That's coming out in about half an hour. The second thing is, I know you've been talking about the markets, but a lot of people looking at the transportation index again. It kind of started the move higher in the overall index. It was a little bit of a leading indicator, both when the markets came off, starting in the fall, and then the bottom. Some people are saying it's starting to roll over again. I think I have a graph here just looking at the transportation ETF, the S&P 500, and the diamonds or the Dow. They kind of track one to the other, but some people are looking at this market as kind of peaking, rolling over. Others are saying it's just a pause before we take the next leg higher.
And remind viewers why the transportation index in particular is important.
I think there's some argument, it's a historical argument, that when you're shipping things as an indicator of a stronger economy, ultimately a stronger economy leads to stronger earnings and stronger share prices. Is it as simple as that, Miles?
Yeah, it's pretty much as simple as that. You're right, Francis.
I don't know, where are you? Are you in the pause or the rollover camp?
I'm on the rollover camp.
Yeah.
Right now. Yeah.
Okay. Second, final thing has to do with crowded trades. Interesting report out of Bernstein. I think this was from yesterday, looking at how popular or crowded trades act relative to the overall market. And this was just a study that was done over the past 3 months. But it looks like, according to the conclusion from this report, crowded trades have underperformed the least crowded trades by about 9.1% globally in the past 3 months. And that was kind of, to me, like a duh, that, everybody's piling into a story. The story gets ahead of its fundamentals, and in the subsequent 3 months, it underperforms. Right now, according to Bernstein's work, the most crowded trades right now are Apple, Microsoft, and Exxon. And there's how they did yesterday. Apple, it's hard to, biggest company, it's not surprising that it would be a crowded trade. Almost everybody has a buy rating on the stock right at the moment. So if you own those, you might see some underperformance over the next 3 months.
Thanks a great deal, Francis.
Okay.
Have a good weekend. That's Francis Horodelsky and the Friday Morning Buzz.
Stay with us, folks. After the break, Amber Kanwar of our affiliate BNN and the blockchain revolution, followed by my weekly talk with Matt Henrik, Senior Vice President, National Sales at Sprott Asset Management. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Welcome back. Well, if the experts are right, just as the internet changed many aspects of our everyday lives, blockchain may soon do the same and more. The father and son duo of Don and Alex Tapscott have written a book on the subject. They say when it comes to technology with the biggest impact, forget about self-driving cars or artificial intelligence, it's blockchain. And as the title of their book suggests, we're on the cusp of a blockchain revolution.
Over the next 18 to 24 months, you're going to see the first major implementations of blockchain that will fundamentally transform business and fundamentally transform our lives.
That's why father-son duo Alex and Don Tapscott decided to write a book on what they call the blockchain revolution.
And it turns out that we work together really well. I think it helps when you share DNA with your co-author.
And while this is the first book for son Alex, he has an experienced partner in his father and co-author. Don Tapscott is a global authority on innovation. He's authored 16 books, including the bestsellers The Paradigm Shift, The Digital Economy, and Wikinomics.
For me, it's like 1993, you know, and I'd say the word internet, and everyone would kind of look at me. And today it's like blockchain. I wish it was a better word, actually, blockchain. I mean, it's not the most sonorous word. It's kind of like
pretty descriptive. It's kind of like this is what's happening. Yeah, it's a block of information on a chain.
A little too literal, perhaps.
It sounds like block and tackle and chain gang. But people look at me like blockchain. Explain that. But once you start to explain, and the dozens of ways that this will be transformative in every institution across government, culture, music, and the opportunities to create a more prosperous world, it's quite mind-blowing.
Some of the most mind-blowing revelations, according to the Tapscotts, is that today's biggest disruptors, like Airbnb and Uber, could be in trouble in the blockchain world.
You go to your app, and rather than Uber, it's like Super Uber, or Suber, as we called it in blockchain revolution. And you say, I want a car, and here's where I want to go, and there are a bunch of cars moving around, and it says it'll be there in 3 minutes. But there's no company that's running all of this. It's just what we call a distributed software application running on the Suber blockchain. And there's actually no reason to have a $65 billion corporation. All of this can be done by software, by clever code, and by collaboration, where the creators of value actually get to keep the value.
And that's where they see the biggest opportunity in blockchain. In a world where social inequality is one of the biggest issues of our time, the Tapscotts believe blockchain could hold the key to turning the 1% into the 100%.
The only way to solve that problem today is to redistribute wealth. So you got government saying we're going to tax the rich more. Maybe we could pre-distribute wealth. Maybe we could change the way that wealth gets created in the first place. Maybe we could democratize the creation of prosperity so that you can include billions of people in the economy.
And it turns out that much of this revolution is happening in our own backyard. Where is Canada in this global revolution?
Well, I'll answer that.
Sure.
Because unbeknownst to many people, Canadians punch way above their weight in the world of blockchain. The leader of Ethereum, the founder of Ethereum, which is one of the most exciting blockchain platforms in the world, is a Canadian, 21-year-old kid who's basically developed the first crowd-funded unicorn in world history. Wow. In Toronto. Canadians don't know about it.
Well, that's probably a surprising answer, because normally it's like, whoa, Canada's way behind. Actually, this is crazy. We could have the center of the next generation of the internet be based in Canada if we do this right.
So before we start waving our Canadian flag, let's unpack a little bit about what was said. The biggest implication here is that the unicorns of our day, today, the biggest disruptors like Uber, Airbnb, are irrelevant in a world where everything's running on blockchain technology. What do you think about that?
Well, first of all, let me preface my comments by saying kudos to those guys for getting out ahead of it, and kudos for Don Tapscott, who's always been seemingly a little out ahead of all of this stuff back to the early 90s, as he referenced. But you know what? I think there's a difference between being a futurist and an operator. Because if you look at the business of Uber, Uber's made up of many different components. Payments are just one of them, right? They are, in my view, they've done a masterful job of connecting and aggregating excess space and capacity with people that demand that excess space and capacity. How you pay for it is one component of a multi-pronged strategy. Likewise with Airbnb.
Uber is more than just payments.
Right? And I mean, it's nice to think and talk about a world where everybody's going to do this on their own, but I don't see that part of it. And maybe it's just me being too practical, looking no more than 18 months ahead, because beyond that, who knows, how people are going to adopt things. And there's been all kinds of mistakes when we get too far ahead of our skis in terms of understanding how people are going to behave. But I've got tremendous respect for companies that had the foresight to organize and aggregate excess space. Connecting people, bringing consumers en masse to any idea is a massive marketing exercise. How you pay for it? Listen, this blockchain thing is going to be fantastic because it's, once again, making things more efficient, cutting out fees, adding reliable technology, secure technology, and there's been a lot of waste in the system, but there's a lot more to Uber than payments.
But if it's more about marketing, then, should a company like Uber be valued at $65 billion if all it really does is marketing?
Well, that's a whole other debate. I mean, to me, there's a lot of examples of companies that are not adding anything concrete to the system. They're just making better use of what we have. That, to me, is tremendously valuable.
There seems like there's definitely a lot of hype around blockchain. And when they talk about this world of creating such prosperity where everybody's on an equal footing, how much of that do you think is hyperbole? Or do you really think blockchain can get us to that point? Because the Internet certainly went a long way to creating a democracy or democratizing certain processes. Do you think blockchain can do that for our society?
Listen, I think it's just yet another example of technology creating massive change in fundamental behavior by attacking things that are inefficient. You could project any kind of utopia you want, and as long as you go out far enough, I have a hard time commenting on that. I just am not prepared to sit here and predict the demise of Uber and Airbnb.
All right. That was some good insight. We hope you enjoyed our show on blockchain. As we mentioned, it is very much in its infancy, but this is just a taste of what could be coming down the pipeline.
Now to Matt Hendricks. Great to welcome Matt Hendricks, Senior Vice President, National Sales at Sprott Asset Management, who is joining us from Toronto today. Matt, I hope that you're surviving the traffic.
Yeah, John, it's a beautiful day. The drive yesterday was nice and smooth, and we're celebrating a young boy's birthday party today, so it's all good.
Now, for listeners, I'd like you to give us your summary of market activity in the various asset classes during the past week based on the performance of the Sprott strategy.
Right. The markets were pretty much benign this week. There was some big news out. The jobs numbers missed yesterday. The market didn't really react much to that. But so basically the markets were flat. Our strategies did very well. Besides that fact, John Wilson's strategy, our core equity strategy, had a phenomenal week. He outperformed the market by over 250 basis points. Some of his stocks moved really nicely, and in the midweek when the stocks were down 1% back-to-back days, his fund was up. And our gold fund and, of course, our energy fund, once again, had posted positive weeks and just continue to show no signs of stopping. So, as usual, we recommend to our clients that, you have a core allocation to fixed income, core equity, and a sleeve of your energy and precious metals, and that's a pretty rounded-out portfolio.
Now I've got Catherine Murray's interview with Eric Nuttall coming up after the news, and really look forward to that. And I must ask you if the Sprott flow-through opportunity is still available.
Absolutely, John. We only have 2 more business days left. So Tuesday next week at noon, we close the books, and Jason is doing a phenomenal job. His 2014 as well as his 2015 edition of the flow-through is up over 50%, 50 this year. And our 2016 Sprott flow-through, we hope, is lined up to have a great, great year being invested in the energy and mining sector. So any listener or advisor interested, please call me at 1-866-299-9906 or look me up at sprott.com, and we'll talk about flow-through.
Okay, Matt. Enjoy the rest of the day, and we'll talk again same time next week.
All the best, John. Have a great show.
Now to the news, and when we come back, Eric Nuttall is the portfolio manager of the Sprott Energy Fund followed by BNN's Paige Ellis, who discusses Hydro One. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
We begin our countdown to the closing bells and asking, is it time to start buying back into the Canadian energy sector? Our next guest says yes, if you have a longer-term investment strategy. For more, we're now joined by Eric Nuttall, Portfolio Manager at Sprott Asset Management. Eric, good to be with you.
Good to be here.
Let's talk a little bit about this and your fund that you run. It's an energy fund.
It is.
So how has it been going, and what did you do during the downturn?
Yeah, we've had an okay year. So the fund's up about 33% year to date. It's the number one performing energy fund in the country. And what distinguished our performance versus some of my competitors is that in December 15, we made the decision to effectively go all in energy stocks because we viewed it as a once-in-a-lifetime buying opportunity. There were stocks that had fallen by 94%, where with fresh money entering into those situations, we saw the risk-reward was overwhelmingly in our favor. So we benefited pretty strongly from some of those positions.
What now?
It's more difficult. It's an easy question, but it's more difficult to answer. So when you look at the strength in the sector, clearly, and I would say for anybody watching, if they've missed it, don't feel alone because 9.9 out of 10 investors have completely missed this rally. And what I think is going on now is that many generalist investors, fund managers, the large like pension funds, over the past month or so, they finally hit their pain threshold where they couldn't take it anymore by not being involved. And that money, which is in the billions and billions, it's been flooding in. And an advantage I have is discussions with every major trading desk in Canada and some in the United States. And that's very evident. So as that money's been coming in, valuations in certain pockets of the energy sector have been secondary. The primary focus has been get money invested now because I can't take it anymore for those people. So in certain pockets, such as the large caps, that's been inflating valuations. And if anybody is watching at home owning a Suncor, a C&Q, they're all sells. The entire large cap sector in Canada right now is an outright sell. Absolutely, and if not short. When you look at valuations, they're well beyond any historical average. A Suncor would be discounting about a long-term oil price of $75, which personally, and we were ahead of the curve in calling for $50 by the end of this year and $60 in 2017. But I think there's a ceiling price of about 60 to 65 for the next year to 2 years because there will be an inevitable supply response from the U.S. But if you're discounting 75, and I think we can only get to 60 to 65, it's very difficult to see how you get rich from owning a stock. So it's already baking in all of the price upside from here.
Eric, you know, that's, I think, one of the most difficult aspects of getting back into some of these stocks. People would say that the valuations now don't make sense, but I do wonder if you're a longer-term investor, if it's still not okay to get in or to own some of these stocks.
So there's going to be a momentum trade, especially in the large caps. My job is to find those pockets of undervaluation where there's still opportunity, and there absolutely is. It's just not as abundantly clear as it was 3 or 4 months ago. But if one can take, and why I distinguish the time frame, it's very important. If you're looking at a month or 2 months, I have zero visibility, no idea. And given the extent of the rally that we've had, could we have a pullback? It's possible, especially with seasonality now. But if you do look out 2 years' time, we could, and we probably need a whole episode to talk about it, but there is going to be a supply crisis within the next 2 to 3 years, given the significant amount of underinvestment in the oil and gas sector. So if you look out 2 or 3 years' time, you could talk yourself into the 60s, maybe even 70s. And in that context, there are many mid-cap stocks which still are being overlooked, which are wildly undervalued. But because everybody was hiding the large caps because they were panicking in 2015, those valuations were kind of artificially buffeted up. And now as oil has rallied from the lows, they were already starting at a very high point. So there is value in the space. You just have to be intelligent in terms of where you find it.
Let's talk a little bit about where you are finding that in some of your top picks. Devon Energy is one of them, Newfield and which?
And Cardinal. So Cardinal would be one that I can very positively say that I would own it today and I would buy it today. So Cardinal is a medium gravity oil producer. So medium oil sells at a discount to light oil. And that was the real reason why it fell more than the average in 2015, because not only was oil falling, but your margins are being extra compressed because they have a $19 discount to their oil price. So as people are getting more optimistic on the price of oil, the very reason that made the stock underperform last year should make it outperform this year. But that hasn't been the case so far this year. It's only up, I think, 7 or 8%. So this is a name where it's trading at about 6.5 times cash flow. Its peers of inferior quality are trading at 8.5 times. So I think there's a catch-up trade in that name. I think fair value is $12, which would be 30% upside from here.
Where else do you see a catch-up trade?
Arguably some still perceived over-leveraged large caps. So one name like a Baytex or even a Devon Energy would be a safer way to play on oil price recovery, even though it's had a very significant move off of the lows. A critical mistake I think investors would make is looking at a stock chart and paying too much attention in terms of where the stocks or the share prices were, just because we never should have gotten to the lows that we saw in January, February. So a Devon Energy capitalized or recapitalized the balance sheet, unfortunately at low prices, but fresh money coming in, you're getting a much better balance sheet and you're getting catalysts surrounding asset sales.
If we can, in the control room, bring up Baytex as well, because I think some people do wonder what's been going on with Baytex. Right. Can you kind of give us an explanation in terms of the stock price performance?
Yeah, so they have extraordinary leverage to the price of oil given their leverage situation, and a key opportunity that we had identified was the perception that they were going bankrupt at a low oil price. And if you spent the extra 30 seconds to analyze the balance sheet and the debt structure, you would have known that it was all in the form of long-term debt coming due until 2021. So they had a lot more breathing room than people were giving them the benefit of. We made an absolute killing in this name. We've trimmed our position extremely significantly from the 650 range, given commensurate valuations now, but this would be a name that I would look to add on a bit of weakness. It's theoretical that in some of these names that have gone hyperbolic, you could get a 10 to 15% correction.
Well, that's what I'm wondering, though. Why didn't this one participate as much as some of the others? Or at least that's what it looks like to me.
Well, to the upside, it broke $2 in January, so the stocks tripled from the lows from 3 months ago.
Okay, it just seems as though it hasn't quite done the same, but I guess in a lower space it has.
From the low, January was not a fun month.
I just want to go back to one item that you talked about, which I thought was really interesting, that we should reiterate, which is if you own the Suncors and CNQs of the world, I'm wondering about Precision Drilling as well, and you have recouped a lot of your losses, but you're probably still not where you were. You still think that now might be a time to sell?
Yeah, I would sell all large cap stocks in Canada at current valuations and roll them into I'm biased here, so roll them into an energy fund with a dedicated expert, or if you want to stick to individual stocks, there are mid-cap names, I mentioned one earlier, that offer way more upside, have even a better balance sheet than many of the large caps. Like a C&Q, the balance sheet is mildly stretched. They're growing into it from free cash flow, but you can find better balance sheets, so way lower risk, in names that have not risen. That you want to go where the puck is going, not where the puck is currently. Everybody is still hiding in the large caps. Fund managers who have $10 billion to deploy, the first thing that they do is they go into large caps, do their homework, and the money flows into the mid caps. So that's where the puck will be going in the months ahead.
Got it. Eric, good to be with you. Thank you very much.
Now to BNN's Paige Ellis and her thoughts on Hydro One.
Certainly, that slow waning of demand for electricity is considered a sort of a long-term risk for investors for Hydro One. But I do want to look at some of the issues that happened back in the first quarter and just talk about those for a quick moment. One was that the really mild weather affected the company's revenue. The government put out a report that I was reading just a few moments ago that because of the warmer temperature this winter, electricity demand was down 6.4%. So, of course, that hits Hydro One's top line. There was also a big ice storm that covered large swaths of Ontario towards the end of March. That one obviously had increased costs for Hydro One because they had to restore service to a lot of customers. But in terms of a long-term trend, we are seeing a slow fade in energy demand in Ontario. I saw records going back about a decade that show this steady decline, and there's a few reasons why this is happening. One is that our appliances and our light bulbs are becoming more efficient. Another is there's, that conservation push underway. And a third one is sort of tied to the economy. If our factories aren't operating at full tilt, they're not consuming enough or as much energy. So that puts a dampening effect on demand and consumption as well. So we are expecting flat demand for energy in 2016. And an analyst at Credit Suisse asked how Hydro One was accounting for that, how they were going to offset what's expected to be a continuing declining trend in energy consumption. And what the CEO of Hydro One said is that they're looking at this and they're exploring some, quote, disruptive technologies to offset that slumping demand. I'd be so excited to know what exactly those disruptive technologies are. But from investors' standpoint, they're concerned obviously about that, but also they're focused on the company's valuation. According to a lot of analysts, the valuation of Hydro One looks pretty rich. It trades at about 19 to 20 times earnings based on 2017 earnings. It hasn't had a full year of reports yet. That's higher compared to its peers. So a lot of analysts kind of cautioning investors to take a close look at this one because it might be a bit rich.
Okay, let's get back to the top and to the top line. Didn't Hydro One raise its bills a few days ago?
Well, the Ontario Energy Board did. So starting on May 1st for Ontario, the average household has to pay an additional $3 per month for electricity, and that's because, to my very first point, it was a mild winter, and they had to offset the losses in terms of consumption from a really mild winter. But that could change, Michael. There could be some change on the horizon because Hydro One has applied for an incentive-based system. Let me explain how this works. Basically, it would allow Hydro One to keep the benefits of improving productivity. Right now, they have no incentive to reduce their costs because as long as they can justify them to regulators, they can just pass them right along to consumers. Well, what Hydro One wants to do, and it's applied to do this, is switch to a system whereby when they cut costs, they could keep some of those savings. And theoretically, that should reduce the bills for Ontario residents. Their hydro bills should technically go down if that is approved. I'll be watching this closely because those hydro bills really hurt every month.
Paige Ellis, live on location at the TSX. Thank you.
After the break, to conclude this afternoon's show, we come to Francis Horodowski's fascinating interview with Roy Sebag, co-founder of BitGold, and James Turk, who is the founder of Gold Money. Stay with us. This is 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Gold Money, which entered the public markets a little less than a year ago on the TSX Venture, moved up to the big board. Roy Sebag, who's the co-founder, CEO, and president of BitGold, and James Turk, founder of Gold Money, are here in the studio to discuss. Gentlemen, good morning.
Good morning. Good morning. Thanks for having us again.
Roy, I understand you told me that this move from the venture to the TSX, to the big board, was done in record time. How did you do that? What metrics did you have to meet to make the switch?
Yeah, it's a good question. I think it's actually known to Canadian capital markets. I think not enough people give credit to the interplay between the TSX Venture and the TSX and just the formation of capital. And if you take our case, we've been able to raise over $70 million in 11 months and create 50 jobs and invest tens of millions of dollars into the Canadian economy. And I think that a lot of people in our position probably a year or two ago would have went to Silicon Valley and been given a lot worse terms and a lot less capital and a lot less flexibility. So I think graduating from the TSX Venture to the TSX for us was very important because we're always about increasing the assurances of integrity to our clients. We're in a trust business, and so it's very important for us not to just operate at a high level of governance, but at the best level of governance. We now operate at the same level of corporate governance as any large bank. And so to us, it's a very important decision to have made this move, and we're very excited about it. It's a big milestone.
You're moving into a lot of different, not different areas, kind of extending your offering. You've got MasterCard. Recently you were talking about the ability to lend against the gold in the portfolios or the precious metals in the vault. How is that? When's that going to happen? How's that going to work?
Yeah, well, if you, again, take a step back and look at what central banks have done, they've messed with the temporal order in markets and have created, all these anachronistic price signals. And as a result, these banks are sitting there thinking, what do we do when we head into negative interest rates? And my favorite part of this conversation is we all assume that the central banks are in control. What happens the next time we do hit an inevitable recession? We will have to go to negative interest rates. And if banks aren't preparing now for how to deal with their plumbing system under a negative interest rate scenario, I think there'll be a lot of embedded tail risks that no one's really thought about. In our case, we're looking at our client base that's growing very rapidly. We're now at almost 850,000 users globally. And we look at the services that we're offering them, and we're offering them deposit service, payment services, but a lot of them are starting to ask for lending services. Right. And so we're coming up with a model that would work in a negative interest rate environment where your fully reserved gold could be collateralized and you could draw a fiat currency loan against it. So in this case, we'd be lending to you from our balance sheet. We'd never fractionally reserve your own deposit. That model is broken, especially broken under negative interest rates. But we think that's very exciting. And I think
when's that going to happen? Are we talking next year, 2 years, 5 years?
We don't move in those large time increments. We move in the days and months. Oh, okay. So I think it'll probably happen before the end of this year. But I think in general, the trends that we're seeing are that our original thesis on why people wanted to use this service turned out to be true.
Okay.
And I think if we continue to do our job correctly, there really will be no reason for anyone to express or expose themselves to gold through a security like an ETF.
Okay. James Turk, I want to turn to you now, if I can, just to talking about gold. You have and silver. You've had a long history of looking at these metals. You're a prolific writer. I think we're going to show our viewers some of the books you've written. I want to address three things. I wanted just your brief comment on the settlement between Deutsche Bank and regulators on this price fixing or price rigging issue. And looks like they're going to turn over their associates or their colleagues in the price fixing arena.
Yeah, that's what the settlement apparently was. And it's obviously new. It's just happened recently, so it's going to be playing out over the weeks and months ahead. But it is big news, and I think it's going to be a positive development to make the market more transparent. That's been a problem with gold in the past. It's been very opaque. But if we make it more transparent, it'll be more liquid, more free, more open. I think that's a good thing.
When we're talking about gold, I mean, gold has been doing better this year. Silver's been doing better, of course, well down from the highs of 4 or 5 years ago. Silver is the one that's getting a lot of attention right at the moment. I know we're talking to the founder of Gold Money, but silver is also in your vaults, and it's that ratio of gold to silver people are pointing to, which is, it's skyrocketed. It's started to come down. What's your view on silver?
Yeah, silver is much more volatile than gold. In other words, if money moves into the silver market, it has a bigger impact, and you can trace that volatility by looking at the gold-silver ratio, how many ounces of silver it takes to equal 1 ounce of gold. Recently, we were up around 80 ounces of silver equal to 1 ounce of gold. Historically, that's very high. And it's also been a level that's stopped the ratio over the past 10 or 12 years. So I expect now that the ratio is going to be falling back toward, maybe 40 or 50, something like that. What that means is that silver will be rising more rapidly than gold in the months ahead.
And what is going to cause that increase in the price of silver? I mean, I think there's a ton of the metal around.
There is, but silver is what I call a gold substitute. People who want to buy gold will look at different alternatives, and they'll see that silver is cheap relative to gold. So even though I'm very bullish on gold, I'm even a little bit more bullish on silver, and I think that's the way people will look at it. In other words, you can buy 1 ounce of gold or 75 ounces of silver, and if at the end of the day you have 1 ounce of gold and the ratio is 30 to 1, in dollar terms, you're going to be outperforming when you own silver.
You've had in the past some pretty swallow hard targets on gold and silver. I mean, I think I read 8,000 for gold, 400 for silver. Those aren't new targets, I don't think. What would justify those kinds of prices for those kinds of metals?
Well, it sounds pretty high.
Is what it sounds like.
We were sitting here in 1971 when gold was 35 and silver was $1.20. 10 years later, gold was 800 and silver was 50. It's the same kind of thing. It's the same kind of situation. Essentially, we're in a value basis where we were back in 1971, but it's hard to make that measure when you're looking at dollars because dollars have inflated over the period of time. But an ounce of gold today still buys the same amount of crude oil it did in 1971. So if you look at it from that perspective, you can understand how cheap gold and silver are here at the moment.
One thing, Roy, just back to you, you mentioned in some previous interviews is that you think that there is no reason within 10 years to have any gold-backed ETFs. And why is that? I mean, that's been a very attractive place for investors to trade gold.
Well, it's been a very attractive place for investment bankers to manufacture financial products off of the math of gold. Let's take a step back. 100 years ago, $1 million of gold would be worth $20,000 today. Conversely, $1 million of gold would be worth $65 million today. People like to say that you need to invest your currency to generate a return, but all things being equal, why does currency erode 98% over 100 years and gold doesn't? Because gold is a currency. In our platform, with our technology, you're using gold as a currency. You're not just using it to buy and sell it. You're using it every day. You're making sure your wage gets paid in gold. You're making sure you're participating in an economy with other counterparties in gold. And so you're getting a fair, it's not that gold went up 65 times. It's just that the currency is devalued by 98%. And so if we do our job correctly, why would you buy an ETF? You can actually drip into gold. You can buy $1 a week worth of gold. We're launching a payroll solution next week where employers such as BNN can pay a portion of your salary in gold. So when you think about gold and all the various use cases and how malleable it is. It's the most malleable of metals, but technologically, it's actually extremely malleable as a currency. There's just been zero innovation. There's been zero innovation around gold. And the investment banks and the banks, when they saw the math of gold working, they manufactured products to generate fees.
Just briefly, Roy, before we let you go, I think I asked you this before, stock trades, there is revenue coming in, but how do you value these shares? How does the street value
So if I have my hedge fund hat on, I'm a bottom-up value investor, I say there's $1 in cash. It's trading at $4.50. There's $1 in cash. The gold money business that we acquired is run rate $5 million right now, EBITDA. What's that worth? $1.7 billion in assets. It's got to be worth between $50 and $100 million. It's another $1.50. And that delta is the option value on BitGold. Is BitGold going to change the world, or is it going to be a dud? And what's that option worth? And that option increases in value in a rising gold price environment. That's how I'd look at it. So, I think we have a very healthy valuation. None of us are delusional about that. But if you asked us 6 months ago if our business would grow three times where it was 6 months ago, I'd say that's impossible. The internet technology business is very scalable. I'm always amazed at how we'll have days that are 3, 4, 5 times better than we had a few days earlier, but yet everyone in the office, I look up above my desk, we have an open office, and no one's really working that much harder. So that's the power of technology.
And that's where we're going to leave it. Roy Sabag, James Turk, thank you very much.
I'm John Budden, thanking you for joining us this afternoon on Money Talk. We'll be back at 2 p.m. next Sunday with the business.